All right, guys, happy Wednesday. Welcome to another week of the Educated Homebuyer Live with Josh and myself, here to update you on what's happening in the real estate world, mortgage world, the economy, all things that drive real estate. So welcome back. Josh, how are you this evening?
We're a little stressed. A document disappeared that is making something a little bit behind schedule, but we'll get it out and we'll make it happen. We'll make the trains run on time if we have to get behind them and push them, Jeb.
Good stuff. So for those of you who are new to this, we do this every Wednesday, 5 p.m. Pacific Standard Time. It's a place to ask or get your questions answered, rather to ask questions, get them answered by myself, by Josh, really to help educate you, guide you through that. For people to join in, let us know where you're watching from this evening. Also, if you have questions, start putting them in because it's a good time.
Jeb,
it's a good time.
Jeb, we have a new and interesting thing tonight. Someone emailed in a question this week. They could not be live. They emailed a question. So if you have a long question, a detailed question, you can't show up live, email us at info@theeducatedhomebuyer, and you could lead off the show with your important detailed question.
Yeah, like I said, we've been doing this for 4 years, almost every Wednesday for that period of time, answered a lot of questions on here. We get a lot of people emailing us questions, and we often address those directly back to those people. But this person asked specifically, said, hey, listen, I watched the live. I'm never able to get my question answered. Can I just email it to you and you answer it? So what we're going to do is we typically go over charts at the beginning of the show, which is what we're going to do tonight. We're going to talk about, again, what's happening with inventory, what's happening kind of demand, some important things out there happening with employment. We got CPI coming out tomorrow. All of these things impact mortgage rates, which in turn impacts buyer demand, impacts real estate, all of the things that you care about. But at the end of those slides, we're going to address that question, or rather answer that question. So if you're somebody listening right now, whether it's on the podcast, on jump in or send us an email. We'll get your question answered, and we'll go from there. Josh, this might be the last episode of 2025. It is next week is not New Year's Eve. It's Christmas Eve. And then the following is New Year's Eve. And I don't know that we have an audience those nights.
I don't know that our audience is that interested in. I mean, they're going to be doing better, more important things. For me as a child, Christmas Eve was the greatest night of the year. So I'm hoping that you guys all have such an experience at your household.
I'm pretty sure if I told my wife I was going to do that, she would tell me that I'd lost my mind. So we're just going to
go find a new wife.
Yes. We're going to say tonight is the last episode of 2025. So if you have a question, put it in there now. We'll get through it or get to it rather. But before we do that, we are going to answer some questions. Actually, we're not going to answer questions. We're going to go through some charts, Josh. So the episode tonight is titled The Housing Market Shift is Over, around the idea of this Resi Club article that I read today that basically shows that year over year inventory is basically declining. So we have more inventory than we had last year this time, but the growth rate is declining. So we're not seeing that acceleration in inventory coming to the market like we were back in 2024. Now, the reason behind it, or the reason he mentions it, Josh, is some of it has to do with stabilizing in markets, right? We talk about real estate being local. Parts of the Northeast, still hot markets, right? I mean, there's still year over year growth, hard to get an offer accepted, while markets in the Southeast having a little bit harder time there. On top of that, you got an increase in delistings, people pulling their home from the market for one reason or another. We often talk about seasonality. This is the time of year where if people's home's not going under contract, they typically pull it off. Like, why would you want to just put yourself through the misery of having people come through your home or not come to your home, and days on the market adding up during this time of the year? And even going in then, to a lesser degree, a handful of markets have seen a pickup in absorption, Josh. Existing home sales have edged up slightly, and part of that's due to interest rates. In fact, probably all of it's due to rates to some degree.
Well, we're going to get to it later in here. I threw a slide in of just year over year changes in mortgage applications. If you look month over month, you're like, yeah, it's increased, but it's still really low. But seeing it year over year and then seeing that in the context of lower interest rates kind of tells you pretty clearly that small changes in interest rates look at this. I was thinking the same thing before I even saw this slide here that you added, the increase in delistings in softer markets. So we've seen people throw this up as, the real estate market is really in trouble. We're seeing people take their houses off the market. Like, that is a sign of weakness in the market, but it is not a sign of lower prices to come, because we've talked about this. One of our very first episodes of the podcast 4 years ago, Jeb, was why home prices are sticky to the upside. Why are they sticky to the upside? Because people get stuck in their mind, my home is worth this. And unless they absolutely positively must sell that home, they'll just take it off the market. You don't want to give me $1 million for my house? Fine. I'll stay here for another 5 years.
With my 2% interest rate.
With my 2% interest rate, with a payment lower than what I can do anywhere else. So I'll sit here and suffer. One of the best examples, a very different market, Jeb, those two vacant lots, it's long since built on 20 years ago on Main Street here. When they first came on the market, the guy was insane. He was asking $500,000 per lot. You and I would both give an arm and a leg plus $500,000 to have one of those lots today. But when he came on the market in the 90s, you're looking at going, this guy's insane. And what did he do? Took him off the market, put him back on, took him off the market, put him back on. And he just waited. And eventually the market for those lots was $500,000, and he got his $500,000. And he is not unique among sellers.
And he's pissed today that
he's pissed. He's pissed that he didn't hold on to them until they were $2 million lots. But people don't have to sell. We talk about willing and able demand. So everyone's willing to live on the beach in Malibu, but not everyone is able. Well, you have selling, the seller version of that. Many people are willing to sell, but they're not able to get their number. They're not able to make it make sense to the house that they're moving on to, with higher interest rates, what it would take to get to that. So we have less supply on the market because we have less able supply. They're willing, they want to list and sell, but they're either not able to get their number or find the right property. So definitely an interesting market.
And again, not to get too deep into that, but I think you'll see some more of that willing supply come on the market in the spring. I mean, with seasonality, just normal people, but also there are some people, again, we've talked about it, Josh, that have those low rates that have finally reached the tipping point, if you will, of saying, you know what, the house no longer works. It no longer serves my needs. I don't like the location. There was something about it that just didn't work. And as much as I'd love to keep my 3% interest rate, I'm just not doing this anymore. And I think as we see mortgage rates continue to ease, you see more of those people willing to let go and bite, the bullet, so to speak, and inventory increases. To what degree? It's hard to say, because that we don't know yet. But with that said, we know the inventory and supply and demand is what drives markets. And this last week, we saw inventory nationwide drop from 795,000 listings down to 775,000. So a noticeable decrease there. Again, this isn't concerning. This is normal for this time of year. Just something we like to point out. In fact, if you look at that chart there, that line, for this year, if you could pretty much lay it across almost every single year on that chart, and it would look exactly the same. But what's happening here in Orange County, what's happening in Huntington Beach? Orange County saw a noticeable decrease. You can't see it because I didn't put it on the chart. I didn't overlay the decline week over week, but it was like an 8% drop in listings week over week in Orange County, sitting down at 3,217 properties now, still above where we were last year. And then Huntington Beach saw a noticeable drop, down 12%, sitting at 200 active listings. Again, not a big deal unless you're a buyer out there looking for inventory. Then it is a big deal because there's just a lot less to choose from. And that's probably not going to change for another 4 to 6 weeks at least, just because of timing and all that good stuff. New listings still up over where we were last year. Again, not really concerning, nothing really to worry about or even mention here. Just thought I'd throw the chart in. Total home sales, again, a little bit above where we were last year, but pretty much kind of lockstep with 2024. We'll continue to edge down throughout the remainder of the year. Properties with price reduction saw a slight decline, but again, kind of just holding there. I mean, the people at this point that would have to do a price decline are probably just pulling their homes from the market, right? So you're not going to see a big shift in that number. It's just probably going to hold steady with what's out there. You'll see some decrease, some pull their homes, and with that, you're probably going to stay around that 39-40% number of homes that have had some sort of price reduction. Now, Josh, when we talk about inventory now versus prior to the pandemic, right? That's kind of the metric that we often use, because 2019 was the most normal market we've seen in the last 5 years. And so this chart basically just shows you the shift between November of 2019 and November of 2025, what's happened in those markets. The dark brown or brown of any color are markets that still haven't reached that 2019 level. Inventory is still low, still declining, whereas the darker the green, the more inventory it's seen. So you can see that Northeast, parts of the Midwest there, still really, really low compared to 2019, whereas the Southeast, a lot of inventory, a lot more choices out there in the market.
The Northeast and the upper Midwest still just confuses me. I don't understand what is all that different from 2019 that we would have less inventory, other than it's an older, more established market. So if we look at tenure in the home, I'll bet you those people have been there longer. So a lot of them built up more equity, refinanced hopefully during the COVID era of super low rates, and now they're just more locked in, and there's less new homes there. So you probably just have more of the lock-in effect, but I don't know of any other great explanation for that. Do you?
No, hard to say. It just, I mean, a lot of those homes are older in those markets, I think. A lot of those are developed communities. When I think of those areas, I think they're not doing a ton of new construction in those markets, right? So the inventory that's coming to market is probably their existing homes, right? Not new construction. Whereas a lot of the Southeast, a lot of that inventory that you see popping up is new construction. It's also a lot of condos, right? Condos, you got higher HOA fees, you got insurance issues, you got all of these things that where people are like, screw it. Either I can't afford it anymore, or I don't want to afford it. This is a pain in the ass. I'm putting it on the market. Whereas the Northeast, I mean, outside of New York and parts of New Jersey, you don't really have the whole condo thing, at least to my knowledge. You have more older single family homes, and those people, just aren't listing for one reason or another. And therefore inventory remains constrained.
And Jeb, that condo stuff is real. I just told you this week, the condo that my sister and I inherited from my dad, 20% increase in HOA dues this year, just a hair over 20%. So, I mean, is it the end of the world? No, but you start looking at it and going, if it weren't for the fact that this was my father's home for the better part of 40 years, and I have a sentimental attachment to it because I was 15, 16 years old and did lots of crazy things in that house and like to keep the memory, I might be inclined to find something that wasn't subject to those increases year over year.
Yeah. No, but it's a lot easier to absorb when there's two of you and when you got a super low tax basis too. So
yeah, there's lots of things in our favor, but it's still sure. Not fun. I threw this one in here, Jeb, not that it is directly related to housing, but it's directly related to the economy. It says the world is running out of workers. So you really don't care about the world. But the two on the right is the world as a whole.
About the world.
Well, we care about the world. We don't care about the world as a mass. So if we look at the United States, compared to 1960, 15 to 64-year-olds are much smaller percentage of the population. Why are 15 to 64-year-olds the important part? Is it's the economic engine. It's the prime working age, and we're getting less and less of them, and we are not unique around the world. So it tells us a couple things. People are worried about AI putting people out of work, and we're going to have universal basic income because no one's going to have a job. We also have a problem that we may not have workers. So it might be a good thing that the machines are coming to do a bunch of the work, because we are not creating humans at the rate that we did in the past. So interesting chart from that perspective. This one, Jeb, Lance over at Resi Club put out a cool report in the last week. This is the variance, the range from high to low of interest rates every year from 1972 to the present. So we had some crazy years in the early 1980s that it was 4% variance from high to low.
That is nuts.
Year. That's a move, right? I mean, we're complaining about 6% interest rates right now. They had a 4% move 3 years in a row from high to low. but it puts it into context. That little white line there tells you what the average is of 1.4. So in an average year, from the high to the low interest rate in the course of the year is 1.4. That's probably more than most of you would think, because we've come off a period prior to COVID where, I mean, the total range over 10 years was like 1.5%. So you just didn't get moves of that size. So it puts things into context. 2022 was a big one, the biggest one we had seen in 40 years. That was a shock. But the last few years have been below average in the range of interest rates. So less volatility throughout the course of the year. And likely, barring something unforeseen, we're going to see that again next year with less than average volatility. But even if at that, if you're at 1% or 1.25% over the course of next year, and we use sort of our midpoint, there's no guarantee that the midpoint is the midpoint. The point that we're at today is the midpoint for next year. But if we said that, it would give you a range of rates around 6.75% on the high side and 5.75% on the low side. That's probably a pretty reasonable expectation of where we would be over the next year. But ask us next December, and we'll tell you how our prognostications.
We'll tell you if we were right or not.
We'll tell you if we were right or we're dumb. So we do have some data coming tomorrow. We had some data yesterday. I did not get most of that plugged in here, but the more important information is data tomorrow. We're going to have inflation. You see these two green boxes, 0.32% on the headline, and then the year over year comes out to 2.99. And I meant to actually put the core in there. The core is at 0.25, 0.26. But if we look at this on the next chart, it shows us what is falling off. So we're having a 0.3 falling off, and they're expecting a 0.3 and a 0.26 coming on. So both of these are 0.3s that fall off. So very good chance that tomorrow we get nothing. You don't see any change in the year over year. So probably not a big market movement, but these are what's called base year effects. Anyone can do this. Jeb and Josh are not geniuses that can sit here and figure out what's falling off and what's coming on. So that's why we start looking at run rates over like the last 90 days, over the last 6 months. And those really haven't changed a whole heck of a lot. We like this because it's a high frequency indicator. We get updates to this daily, 2.6% in terms of what we are seeing today for Truflation. This has a 94% correlation over time to CPI. So it gives us a look at this. And really for the last 60 days, we've kind of been in a range there from 2.4, 2.35 to about 2.6. So definitely better than what the Fed is seeing in their numbers, but higher than where anyone wants it. And just seeing that normalize. I threw this one in, Jeb, because it's kind of shocking. Generally, when we get inflation is led by energy costs, energy led by oil costs. And you can see here from COVID through 2022, sort of the breakout of the conflict in Ukraine, we had a precipitous increase in the cost of oil, and it's been headed nowhere but down since then. And it's sort of a conundrum for many people because they were thinking, hey, we have a relatively good world economy, should be high demand for oil, and we're just not seeing the prices do what a lot of people expected. So it makes it doubly shocking that we're seeing the higher inflation that we have. We always talk how we don't put a whole lot of stock into the GDP now stuff or its impact on what's going to go on with interest rates. But one thing I do like to show, we are heading here to the very, very end of the quarter. And you see this divergence throughout the quarter of the blue line, which is the blue chip consensus, and then the green line, which is what the GDP now is telling us. But they always seem to converge here towards the end of the month. And we're going to be around 3%. So if you remember, Jeb, early in the year, I think for Q1, we had minus 0.3. And then the next quarter, because of the front running of the tariffs, we had 3%. So it kind of balances out to about 1.5%. And then we've settled in the second half of the year around 3%. So solid growth, but it's not evenly distributed if you dig into those numbers. So what are the charts telling us in the bonds? Here is the 10-year. We are definitely still broken out of that nice downtrend we had for about 3 or 4 months. But if you really look, the yellow and the red lines kind of show us this sideways trend for the last two months or so. And that's probably the more accurate. We've just been chopping around in this range until we get something that gives us more direction going forward. So what I did want to show here, this is the Housing Wire chart of just showing what spreads are. And spreads are at some of their lowest levels post-COVID. COVID. So that's helping some. So even though the 10-year is not coming down, mortgage rates are doing better than they otherwise would. And this here is our chart showing from Mortgage News Daily what they're reporting. 6.25, that's down 0.03% week over week. So basically flat week over week. But the important part there is a year ago, rates were 0.5% higher, 0.65 higher. If we look at FHA and VA, more like 5.875, and also he's reporting 0.4% higher, but at least 0.5% higher year over year. And if we look at this, the aggregate totals of purchase applications, you can see that they've been higher the last 2-3 months, as almost throughout the year. And throughout the year, rates have been lower. So small changes in rates will lead to big increases in purchase applications. And if we did like they do with the other charts when we show like 2019 and 2020, these are both dwarfed. Purchase applications are very, very low.
They wouldn't even fit on the chart.
They would be a little white line or a little red line at the bottom of the page. But I thought it's interesting because people say, oh, affordability sucks and interest rates don't matter for demand. They absolutely matter for demand. And small decreases in rates do lead to big increases in purchase applications. So if you do get rates at 5.5%, 5.25%, 5%, this will exponentially grow. Still won't put you back to where we were during COVID, but going to be much higher.
All right, guys, if you're watching this, you have questions, going through the pre-approval process, looking to get started, need an agent, jebsmith.net/start will get you in touch with me and the team. We can guide you through that process. So we often ask you guys, hey, if you have questions, I mean, that's why we're here, right? That's the purpose of the live, is to educate, to guide, and to really, put you guys in the driver's seat with knowledge. And so we ask you to come here, ask your questions. We answer them. And this Daniel, I believe, could not make tonight's live. So what Daniel did was he sent us an email, and we decided to answer the question live on the show. So Josh, I'll read it here. I'll be completely honest. I didn't even read the question prior to posting it in here. I just
you didn't want to be corrupted. You didn't want to do research.
I didn't want to think about the answer.
We're doing it live. It's a live Q&A show.
Right on. So he could say anything in here, Josh. I mean, he could have said something negative about us, and I just posted it, but he didn't, I don't think. So let's read it. It says, 3 years ago, my sister took out a personal loan of $15,000. She did not qualify on her own, so I co-signed for her. She pays the entirety of the bill every month. She has never missed a payment and has positively boosted my credit score. There is about $10,000 remaining and 2 years left on the loan. My understanding is that because I co-signed for her, when my credit gets pulled, my mortgage lender, by my mortgage lender, that fee will show up on my DTI, even though I don't physically ever pay it. This, in effect, will lower the amount I can qualify for, basically, when buying a home. My question is, does having my sister refinance the loan so that I am no longer on it help me in a substantial way, or will the savings be minimal? Just go with that, Josh. I mean, I think you can answer.
We can answer with that, but there are some good details here. So let's just buzz through the last of it. Will it help me get a lower interest rate, or will it only affect the maximum amount of money I can be loaned? To my understanding, it takes 30 to 60 days for the refinancing to even show on my credit report. Not sure if you need this, but I make $132,000 a year gross. I'm looking at a 30-year fix. No other debt but my sister. Sure. 800 credit score. Looking for a house in the $800,000 to $900,000 range, which is important. And I'll be putting roughly $300,000 for the down payment. Also really important.
Sure.
So let's answer the basic one that's probably universal, and many of you listening may be feeling this. He co-signed for a loan that someone else makes the payment. They are both responsible on it, which used to be important, but which is no longer important. Even if this were only Daniel's loan and we're in his name, if his sister makes the payment every month, and we can show that for 12 months, we do not have to hit that payment against him. Even though his sister is not technically responsible for it, she has been responsible for it in the last 12 months. And that's a hypothetical. I know that's not his situation. But as long as we can show that that payment has been made for the last 12 consecutive months on time from an account that Daniel is not an account holder on, we can exclude it. There is one and only one exception here where the co-borrower must be on the application, and that is if it's a mortgage. If we're trying to exclude a mortgage, they absolutely positively have to be obligated on the loan, or we can't exclude it. But now we go into the other questions: is should I have her refinances and pay this off? There's really no benefit to you as long as you can exclude it. Even if we can't exclude it, we're talking a $500,000 loan against an $800,000 purchase with someone that makes $10,000 a month and has no other debt to income ratio wise. I don't think this is a problem. Paying off an installment debt won't make an improvement to the credit. It shouldn't hurt it either. He's got an 820 credit score. So if that's his preference, if he would like that and it would just give him peace of mind, great. But there's no need to do that here in this situation. Sort of the last piece that could apply to any or all of you. If you have a debt that you want to pay off, a co-borrowed debt that you want a co-borrower to pay off, as soon as we can show that thing is paid off, we can exclude it. It's not going to show on your credit report and impact your credit report immediately. But let's say in this situation, he's been making the payments the whole time. And he says to his sister, hey, this is screwing me up. I don't qualify. You need to go pay it off with a refinance and get it in your name. As soon as we can show that it was paid off and there's a zero balance and how it was paid off, you're going to be fine. So a lot of worry and concern here from someone who obviously does a great job with their finances, but no worries here in this situation.
Yeah, and it sounds like you're well qualified. I mean, just based on the numbers that you sent there, 800 something thousand purchase, $300,000 down, $130,000 income, high credit scores. I mean, you sound like a really good candidate there. So it sounds like you've been doing the things the educated home buyer way. So congrats on that, and appreciate the question as well. Kind of help start off the show on a good note there. Josh, we have a question here about a program that we have not seen in some time. What are your thoughts on the California Dream for All program? Is this still around? I mean, I don't even know. Is this back again?
They are talking about doing it again this year.
Do you believe it's worth considering?
Last year, we had about 3,000 reservations for a state that has many, many millions of people and many, many people who qualify and would like to buy a home. I did a very detailed video on this. It is the most viewed video on my channel, my small YouTube channel, Jeb. So if you really want the details, go over there to @JoshLewisCMC. Check it out, and it'll give you all of the details. But here's the simple answer. It shocks me, people that want to argue against this. I would never do that. That's crazy. I'm not sharing my appreciation. If someone gives you the 20% down payment, that gives you a smaller loan, smaller payment, avoids mortgage insurance, and all they expect
allows you to buy a house where
allows you to buy a house that you probably would not otherwise qualify for, and then just says, hey, for the portion of my house, your house that I paid cash for, I would like the appreciation on that portion. It's a no-brainer. It is literally a no-brainer. If you can get the money. So again, 3,000 of them, you had to go through a reservation process. I think I had 12 or 13 people apply last year. On the first go around, none of them got a reservation. A lot of people didn't end up moving forward. So that you only had like 90 days to find a home. So there was a second chance, and we had 2 or 3 people get through on the second chance. But from that perspective, it's a no-brainer. If you can get the money, take the money. There's no math. There's no spreadsheet. There's nothing you can do or show mathematically that says you wouldn't do this. You take the money.
Take the money. All right. Josh, let's see. We don't have a ton of questions in here tonight.
We got lots of people claiming where they're from. You didn't ask, and they just said, I'm going to tell you. I'm going to tell you where I'm from. Did you?
Yeah, bro.
I was so distracted by my problems, Jeb, that I didn't even recognize that you did
your problem get solved? Is it a solved problem?
It seems to be resolved here. I don't have a 100% confirmation just yet.
Should we do a live where you get them on the phone and we listen to the conversation? If it doesn't go through?
Oh, that would be a more entertaining conversation. But Sergio is awesome. He is stepping in and fixing my issues and going to get this out so we close our deal on time on Monday.
All right. We got a question here asking, is the East Coast still immune to price drops? Josh, has the East Coast ever been immune to price drops? And what are your thoughts?
Nowhere is immune. The entire country as a whole has, it's sort of like the COVID vaccine, Jeb. It's partial immunity. It kind of makes you safer. But when we look at where we're at, why are we not seeing wholesale price drops across the country? Because we have people sitting on record levels of equity at record low interest rates, and rents are also very high. So people just would just not sell. So we have limited demand, but we also have limited supply because of that. So we have a supply demand balance that keeps us kind of churning along here with flat prices. We talked about this with the slide that you threw up there, Jeb. The Northeast is unique, far more built out, older housing stock, people longer tenure in their homes. So, it's unique, and you saw that in the chart in the fact that there's less inventory available for sale. And as long as that is the case, I wouldn't call it immune, but I would say it is probably the safest place to be if you were concerned about home price drops.
At the moment, right? It wasn't always like that, right? There were times during the pandemic. I mean, not during the pandemic, after the pandemic, where things were kind of, I mean, it wasn't as crazy as it is now. And then all of a sudden rates started moving down, and that area just went banana. Of the East Coast, right? Just the Northeast there that seems to have quote unquote that problem. But we are at a position, or a point rather, where not a lot of questions coming in. So if you have questions, make sure you throw them in the chat. If you're on Instagram, you can throw them in there as well, and we'll answer your question. Watching two different screens here, Josh, because YouTube's the main one. Instagram's kind of a new thing over here, so we're putting it in there. We got a banner across my head, so it's great. All right.
We have a comment here, and it relates back to a conversation I had with a listener today. Mr. A. Guzman says, my parents always said the 80s were the best time to invest. There's some truth to that. And there's some reasons historically why there's been. It's been a great 40-year run, right? If you invested some bucks in the 80s, you are pretty happy about having done that right now. But there's also this. I
mean, if you invested in 2008, you're pretty happy now. I mean, let's be honest.
Well, think about it, Jeb. There's always this saying is, when was the best time to plant a tree? 50 years ago. And if you didn't plant a tree 50 years ago, when was the best time? Today. Yeah, the 80s were a great time to invest. If you weren't alive in the 80s, if you weren't of income earning age and having money to invest in the 80s, there's no sense in crying over it. There's opportunities in every age and era, including in housing. You know, the next 40 years will probably not look as good for housing as the last 40 years. It's still going to look much better for homeowners than it does for renters.
All right, good stuff. Question here asking from Slime Dog, asking if we ever ended up buying and renovating that house.
Slim Dog. Don't insult him. Slime Dog.
Slime Dog. We don't have a Slim Dog. We got a
Slim Dog. Come on now.
Slime Dog. Buying in Santa Ana, we did not. More issues on that property than I care to talk about. But the long and short of it is it was not in the trust, and the homeowners do not want to pay an attorney to deal with it. Long story. So it's probably going to go to foreclosure, and there's going to be a couple $100,000 of equity. Just
I meant to ask you about this yesterday, Jeb. I'm not ready to give up. We're gonna put some VAs. We're gonna get some people.
No, we can't do it.
Going to the Philippines.
You gotta have a trustee that's willing to cooperate, and I don't have that, and so it's very difficult. I mean, I was willing to put up the money for the attorney. I was willing to put up the money to bring the mortgage current, to make this deal work. And I just needed somebody to contact the lender to have a conversation to figure out what was owed, see if there was a way they would work with us. And nobody ever got back to me. So I've since given up.
Just ghosted you? We wouldn't even say yes.
I mean, they said they would and didn't. And honestly, like, it takes time to have those conversations, and they have to want it. And if they don't want it, then you've got your money tied up into something that is could be a problem down the road. And if they're not cooperating now, knowing that they're going to get like $300,000-$400,000 in equity out of this thing,
well, that's the problem. The hell? He's not getting the $300,000 or $400,000. So maybe that's we got. Well, he doesn't care about the kids, obviously.
Literally,
maybe we got to put a little carrot in front of his snoot.
But anyway, so that's where we're at. That could work, but that's a different conversation. All right. Question here from
Real Mad 46.
Real Mad 46.
Not Roll Mod, Real Mad.
Dude, I need a screen your size. I don't have that. Do you have any updates on the Arizona market? So last chart I had, so I received a bi-weekly report on, I think it's bi-weekly, Josh. Is it bi-weekly or monthly? On the Arizona market, primarily, not Arizona as a whole, primarily Scottsdale, Phoenix, that market. And it looked like more balanced than anything else. There were still some inventory was not increasing at the rate that it had been, so it had slowed. Obviously, seasonality plays part of that. It's also the time of year, right? In that market, right? The worst time of year to be a seller in Arizona is the middle of the summer, right? Just because nobody's looking to buy when it's 175 degrees outside. Now is the market, but it looks like it's more balanced. Still have inventory, and I think some markets out there are moving sideways to slightly down, while others are stabilizing more so.
Let me say this: the buyers that I have out there in that market, this is anecdotal, right? but very indicative of the show. Right at that median price point, and we've done a couple 400,000s this year, a 600,000, and another that's missed out on like 4 really nice properties in that $600,000 price range. So that's middle of the bell curve for that market. And all of these buyers were looking at nice properties. They weren't looking at, hey, subpar properties. I'm going to take that back because I'm overstepping the truth. One of those was not particular. He was going through a divorce and was like, I just need a house. And he found a nice house, but it needed some work, needed some sprucing, some cleaning. And he got in and got a good deal and prices, got some of his closing costs covered. But most of the folks I'm looking for, they want the pretty turnkey home, and they're right in that middle of the bell curve. And that market is softer, right? You can see from the data that report tells us that it is. But if you're looking for the nicer properties in your price band, you're not going to be able to just roll in and dictate the price to the sellers. And the one buyer that we're dealing with out there, he can't wrap his mind around it. He says, I read Cromford, I look at it every month, and it tells me it's going to be soft and it's going to be softer. Yet you make an offer and you're trying to tell the seller, this is where the market is, and another offer comes in higher, and we've lost that property. So it's not a matter of you're wrong. It's a matter of there's not one market.
It's not a matter you're wrong. It's just a matter of you're not right, Josh. Mr.
Is that what you tell your wife?
No. She tells me that. Mr. A. Guzman has a comment here. It just says, I'm buying a home now in the city of Ventura, taking over an assumable loan. Thanks to you guys. I appreciate all the information you guys provided. So here's the deal. We helped you. Now we want more information. We want to know purchase price. We want to know how much is owed on the current seller's loan.
What was the
We
gap?
want to know the interest rate. We want to know some details. So give us some details so that we can have the conversation. Because what I've seen more often than not is the phantom assumable loan, this great interest rate and everything, and then it's you need to bring $500,000 in, and people are like, "What? I can't do that."
I don't have $500,000.
Yeah, exactly. So we want to know your deets so that we can just see what's out there. Gives people some hope, especially if there's if there's a small gap that you have to cover. All right, Mr. Lewis, no questions over there. And is Slime Dog asking any more questions? Is Slime Dog our homie? Did he change his name?
I'm working on getting a CD out here.
Oh, Josh. Josh is working again. This is supposed to be a time where we just we're here just shooting the breeze, Josh. All right. Hunter Mitchell. I have a question. I'm a military member moving from Germany to Florida this coming July. So first off, thanks for your service. What time should I start the home buying process, and do I need to be back in the States before starting? So second part of the question, easy to answer. No, you do not need to be back in the States to start the process. You can have the conversation anywhere. Use WhatsApp. It's really easy to communicate. But secondarily, when should you start? So you didn't say, so July. So if I were you, I would probably start that process probably by late March, early May. That's about 3 months in advance. Have credit run, provide documents, pay stubs, DD-214, whatever it is that needs to be supplied there so that you can get pre-approved, and you'll have a good idea. You can start looking at homes online, and when you get back, you'll be able to hit the ground running. So, Josh, more than 3 months in advance, or 3 months sufficient?
I would want to look at it as early as possible. So we have some important things. A military member moving from Germany to Florida. There's just some moving parts there. We want to know what the orders look like, what the new pay is going to be, what the new housing allowance is going to be in the new market. If you're separating, that can make some big issues with that VA loan, because if we have a separation date within the next 12 months, which it will say in your LES, there's just some moving parts there. So for a veteran, I would move it up even more. Never too early, especially for a veteran.
All right, good stuff. Platinum Black says no more questions. So you just change your name. Change your name, dude. You can't do that mid live stream. You got to go back. Got to go back to Slime Dog. Slime Dog Millionaire. Okay, let's see what we have here. Josh, not Nothing over here. Rick says, hey, Jeb. Hey, Rick. Saw your comment earlier. I appreciate that comment that you commented on little post that I put out there. Outside of that, not a lot of questions coming in on the home buying process. I do want to say this. This week, or was it last week? Last week? Maybe last Friday. Last Friday closed number 17 of the year, Josh. Homes out of those, 6 of those 17 were people from the show. So here in Southern California. So if you are watching, you're a home buyer here in Southern California, can definitely help guide you through that process. Make sure you reach out. I actually had somebody reach out today from another channel I started, Josh, earlier in the year, and had a conversation with her as well. So here, not only to answer your questions, but to actually physically help you guys. So if we could be of assistance, whether it's the mortgage side or real estate side, make sure you reach out. There's links in the description of the video. You can get in touch with us directly, and we can help guide you through that process.
I was just looking through the story, and I gotta update it over here, Jeb. But what on the mortgage side, about 54 or 55, and I got 2 or 3 more to add. Some of them won't close until January, but definitely a lot of you listeners been able to help. A couple, just 2, 3 this week. We have a listener down in Florida are buying a second home in Florida.
We have the ultimate story once it closes, Josh, of a listener. I mean,
don't jinx us.
Between 50 years of doing this stuff, over 50 years, probably the craziest story I've ever heard, to be completely honest. And so, I mean, fingers crossed that everything goes well, but yeah, anyhow. Let's see here. Real mod again. One more question if you have the time. Have you ever purchased a new construction home? Did you guys find a better deal? Thank you. I'm not sure about the second part of the question there, Josh, but have you ever bought new construction?
I have not. My mom did when I was 15, but other than that, no.
I did back in the heyday when I bought some investment properties. I've told you guys the story about a client that I had at one point that he owned 75 homes at that time and was continuously purchasing, in these markets that were expanding. He would go in, and I mean, if you want to know how to invest, I mean, this guy really he knew how to do it. He would go find these emerging markets where they were building out infrastructure, hospitals, businesses, whatever, and then go in and make these deals with the developers. And he essentially had his group of investors that he had created, and he would go in and buy multiple homes, and he would cut deals and do some other things. But he was buying in markets that were, that nobody even heard of. And then obviously the crazy part is during, the heyday of the GFC, I'm assuming he got crushed, but I've also assumed that he was probably able to negotiate and modify all of those deals to much lower purchase prices or loan amounts and interest rates and so on and so forth. But I don't even know where I was going with that story, to be completely honest, Josh. I just new construction, and at that time I had bought a new construction property, but that was a long time ago at this point. But did you guys find a better deal? I'm not sure how to answer that, how it relates to the other. So maybe you can clarify.
Better deal than what? Better deal than the resale market. Anyone trying to compare historically, when Jeb did 15 years ago, there's no comparison. We've never had a market like this where builders have reacted by saying, I will buy your interest rate down 1% from where the market is. And we've got a listener, Jeb, that I got to get back to, that sent over a loan estimate this morning. Say, will you take a look at this? I think there's a bunch of junk fees in here. You're like, well, they're buying your interest rate down to 4.875%. I mean, the market is at least 0.75% higher than that right now. So I get probably once a month, maybe once every couple of weeks, a listener reaches out, hey, we're buying new construction. Will you look at this? This looks like a terrible LE. And you look at it and it has a ridiculously low interest rate. I say, well, what did you think it's going to look like? We've gone through this multiple times on the show. A friend of mine here in Southern California is buying a $600,000 house. The builder says, hey, we're going to give you $30,000 for your loan. And when you look at it and you compare apples to apples, LE to LE, there was like $12,000 of BS garbage fees in there. but take 30,000 or 12,000 away from 30 and it's $18,000 that no one else is going to give you. So when you're getting $15, $20, $25,000, it's just a horse of a different color. You can't say, did I get a better deal? Better deal than what? You know, depending on what they're doing, you're getting something that's qualitatively different. Existing homes generally on bigger lots, larger square footage. Sometimes what we're getting now is 2-story homes on a lot that's 1,500 square feet smaller. So we can't just go off of new and say, oh, I don't need to do any upgrades. There's more to it. There's qualitative differences, and then the financing is just a horse of a different color.
There you go. And I've also realized, Josh, you can't compare apples to apples. They're not the same. They're not the same. My family likes sour apples. I like sweet apples. And then I buy sweet apples. They eat all the sweet apples, and then they leave me with the sour apples. And then I don't like the sour apples. So then I'm stuck with no apples because then they eat them all. And so I don't know if that made any sense, but that's where I was, just wanted to get that off my chest. All right, guys, it is 45 minutes into this. If you found any value, make sure you hit thumbs up, subscribe to the channel if you haven't done so already. Not a lot of questions in here, guys. This is the last episode of 2025. We're going to take the next 2 weeks off. A little mental health break, Josh. I think we need it. I need it. Do you need a mental health break?
We'll go for a long run, clear our heads.
Jeez, that would be a long run. Okay, guys. Questions. It's time. I'm not going to sit here and just yell questions. Josh, anything you want to say then, Mr. Lewis?
No, been an interesting year. It's been a good year. They're all interesting, right? They're interesting in their own way. 2021 and 2021 was nuts interesting. 20 was COVID. 22 was shifting market. Last couple of years has been what in the heck is going to happen with interest rates? When are they coming down? So we all think we know what's coming next, or at least have a solid opinion about it, but we'll see how it plays out.
All right. One more question, Josh. Do lenders consider all of a 401k and HSA with qualifying? If not, what's the percent they would consider?
I don't know what we mean by with qualifying. Most loan programs, FHA, VA, conventional, they don't require reserves. So those are assets. So are we using them? If we're going to use them, we have to show the ability to liquidate. If we're getting a loan, we have to show the loan documentation. So they're not just looking at it in HSA. I don't know that it can be used for reserves because I don't know that it can be tapped in an emergency. It's funny. I've never had that question raised before. I don't know.
I don't think you can use that for anything other than
so I don't think it could even be used for reserves because it's used for qualified medical expenses. But in terms of the 401k, we're looking at that and going to say, do we need to use it? And if so, even if we're just using it for the reserves, we have to show the terms of withdrawal that you can access it in an emergency, what type of haircut you would have in that case. So it really comes down case by case of what we're using it for, reserves or actual closing. Are we taking a loan or a withdrawal, or are we just using it for reserves? And we still need the terms of withdrawal to show that you can access it if you needed to.
All righty. Good stuff. We had Dixieland just came in and just made a comment, just said, I bought my first house as a very uneducated person, a contract for deed, 11%, no qualifying, handing the seller $5,000 in signed paperwork without doing any checks on the title. Got very lucky, no liens. So that was back in the day. You could do that sort of thing. Now you definitely have to be a little bit more careful and cautious out there. Let's see, $85,000 mortgage. So congrats to you on making that happen. What's that property worth today? What's that property worth? Let us know here in chat. While he's doing that, I just want to say again, thank you guys for another great year supporting the channel, supporting Josh and I, reaching out to allow us to assist you. Grateful for that. It's been a fun journey. We continue to do it because we love seeing the results, love handing buyers keys, and the comments of us being able to help you guys. So if we can do that in 2026, make sure you reach out. There's a link in the description of the video. We appreciate you. But until 2026, guys, buy right, borrow smart, and build wealth. Adios,
amigos.